3 months ago, Delta's April call was framed almost entirely by what management could not yet say. Fuel had spiked violently on the back of the Middle East conflict. Full-year earnings guidance had been withdrawn. Capacity was being cut on a downward bias. The word hopefully appeared more than once. The question was not how far Delta would grow in 2026, it was how much damage the fuel spike would do. On Friday, Delta affirmed that full-year guidance. All of it, $6.50 to $7.50 earnings per share, representing 20% growth year over year. Free cash flow of $3 to $4 billion. And a new target, gross leverage of 2x by year-end, with 1x in the longer-term crosshairs. The turnaround from April to July is real. But what's more interesting and more instructive is how management chose to narrate it. The guidance comes back. In April, Dan Johnke's financial outlook was built around a single constraint. He could not see far enough through the fuel volatility to give the full year any shape. We woke up this morning with a very different set of fuel assumptions than we had when we went to bed, Ed Bastian said at the time. The full-year guidance that Delta had set at the start of 2026 was suspended. Responsibly, it was said, given how dramatically the environment had shifted. Friday's call began with its restoration. For the full year, we are affirming the guidance that we set at the start of the year, even with a multibillion-dollar fuel headwind, Bastian said. CFO Eric Snell was more specific. The affirmation of that guidance reinforces that Delta's durability continues to improve relative to prior cycles and to the industry. That word, durability, did a lot of work in April, too. The difference is that in April it was a claim about what the model was designed to deliver. In July, it's a claim about what the model just delivered. What also changed, the Q2 numbers came in above the guidance provided at the start of that quarter. Pre-tax profit of $1.4 billion. Operating margin of 9%. EPS of $1.56. All better than the targets set in April. The guidance restoration is not a technicality. Delta delivered the quarter and then told investors the year was still intact. The structural change thesis pays off. In April, Bastian made a prediction. High fuel prices, he said, are the most powerful catalyst for change in the airline industry. He expected structural reform, consolidation, rationalization, elimination of unprofitable business models to accelerate. It was framed as a historical pattern he had lived through multiple times, and he was confident it would repeat. 3 months later, as we predicted, structural change has accelerated, enabling the industry to recapture this year's fuel cost inflation at the fastest pace of any recent cycle. Management noted that even after recent fare increases, airfares remain 10 to 15 points below overall inflation since COVID. Ultra LCC capacity is down roughly 30%. The low end of the market still needs another 5% fare increase just to reach break-even at current fuel prices. These are the specifics behind what April's call promised in general terms. The Q1 prediction was the setup. The Q2 call was the answer. Premium segmentation, commitment kept. In April's Q&A, Michael Linenberg asked Joe Esposito about further segmentation of the premium cabin. Esposito said Delta was full speed ahead and on target for where we want to be by end of the year. He added, "You can expect more from us in the next couple of quarters." Friday's call confirmed delivery. The rollout of basic, classic, and extra offerings in Delta Comfort Plus was described as complete. Expansion into the full premium cabin set, including Delta Premium Select and Delta One, is underway this quarter. The narrative commitment made in April has a corresponding execution event in July. One detail worth noting, main cabin RASM actually exceeded premium RASM in Q2. This is a function of premium capacity growth being positive while main cabin seats are down 2 to 3%. Delta is deliberately shrinking the cheaper part of its cabin while growing the expensive part. The segmentation rollout is arriving into that mix. MRO on track and then some. The third-party maintenance and repair business generated $380 million in Q1, more than double the prior year. Dan Johnke described the Q1 figure as unusually high, a function of a strong backlog and heavier work scopes, and warned the growth would be lumpy. The full-year target was $1.2 billion, up nearly 50% from 2025. In Q2, MRO delivered revenue growth of more than 30% year over year. The $1.2 billion target remains intact. And Johnke added something that was not in the April prepared remarks. Over the next several years, Delta expects to more than double MRO revenue while expanding margins. The long-term ambition got larger. The margin trajectory, current low double digits, targeting mid-teens. Johnke described roughly 200 basis points of annual margin expansion as the expected pace. Whether the revenue doubling timeline comes with equivalent margin expansion will be worth tracking. From downward bias to managed normalization. April's capacity language had urgency behind it. Management was meaningfully reducing capacity and explicitly maintained a downward bias until we see the fuel situation improve. Joe Esposito described targeting off-peak flying, edge of day, red-eye, as the first to go. The phrasing suggested an active defensive posture, not a neutral planning exercise. The July call describes this differently. Q2 capacity came in at approximately 1% growth. Q3 is also planned at 1%. Q4 is guided to 2 to 3%, which Bastian described as returning to a little bit more of a normalized capacity run rate. The downward bias is gone. What replaced it is a disciplined ramp, measured, not defensive. The transition is presented as logical progression. Fuel recapture is working. Industry behavior is cooperating. Delta sees no incentive to reintroduce unprofitable flying. The posture shift is real, but so is the continuity of intent. The gap between April and July is narrower on this topic than the language might suggest. Mexico, still soft, slowly improving. In April, Esposito cited Mexico leisure as one of the few geographic weak spots, attributing it to incidents in Puerto Vallarta. Capacity was taken down for the foreseeable future. In July, the characterization persists but moderates. Latin America capacity was down 7%, mostly in short haul, and Mexico is slowly coming back. Fourth quarter improvement is expected. It's not a reversal. It's not resolution. This topic is still alive in the same form it appeared 3 months ago. The pilot contract disappears as an explanation. April's call included one of the more explicit acknowledgments of an internal operational problem that Delta has disclosed publicly in recent years. Bastian said directly, reliability and recovery haven't met consistently enough our high standards. More specifically, the causes included contractual changes to our pilot working agreement that came into effect over the past year. John Key used the Q&A to confirm this. The operational resilience problem was tied to those changes, and the team was working through it. In July, the operational picture has improved. Completion factor improved through the quarter. Baggage performance hit records. NPS is at all-time highs for flight attendant and pilot people interaction scores. John Key reported continued progress on crew resourcing, more people process technology around that. What's absent is the cause. The pilot working agreement is not mentioned. The contractual framework that was named as a driver of recovery degradation in April simply does not appear in the July call, not to declare it resolved, not to provide a timeline for resolution, not as context for ongoing costs. The metrics improved, the diagnosis was retired. That absence is worth sitting with. Either the pilot contract issues are genuinely no longer the operative constraint, in which case some explanation of what changed would be clarifying, or they remain a background pressure that management has decided no longer warrants a prepared remarks acknowledgement. The Q2 transcript doesn't answer which. The conflict becomes a route destination. Bastian opened April's call with a statement of concern. I want to acknowledge the ongoing conflict in the Middle East. Our thoughts are with all those affected. The conflict was then the direct cause of the fuel spike, unprecedented, roughly double what they were earlier in the year, and shaped the entire forward outlook. In July, the Middle East appears in a different register entirely. Bastian mentioned Riyadh and Tel Aviv as new international route destinations. The region is now cited as part of the expansion opportunity. Asia and the Middle East will be the focus for the next couple of years, Esposito said. The humanitarian acknowledgement from April is entirely absent. The conflict that provided the narrative frame for a quarter's worth of headwinds has become an addressable market. That shift may reflect genuine improvement in conditions on the ground. Or it may reflect the selective framing that comes naturally to a quarterly earnings call. The gap report does not adjudicate which. It records the change. The same fuel, differently framed. April's fuel language was tactical. Management cited a specific forward curve assumption, $4.30 per gallon, and described the effort to recapture 40 to 50% of a more than $2 billion headwind in Q2. The recapture process was expected to lag 60 to 90 days historically, though management was seeing a quicker response. The tone was defensive and operational. These are the numbers. This is the gap. This is what we're doing. July's fuel language is structural. Actual Q2 fuel came in at $3.93 per gallon, better than guidance, as lower crack spreads offset the refinery outage. But the framing is no longer about this quarter's recapture percentage. It's about validation, the fastest pace of any recent cycle. The fuel headwind is recast as a proving ground. Bastian noted that fuel today remains approximately 50% above where the year started. That's not a small number. But the architecture of the July discussion treats elevated fuel less as a current threat and more as a structural test that the business has passed. The word resilience in Q2 carries different weight than it did in April. The LCC narrative, from warning to verdict. In April, Bastian spoke about low-cost carriers with the forward-looking confidence of someone who believes the outcome is predictable. Business models that I think their owners are going to start questioning whether they continue to commit capital to. The language was anticipatory. Something was going to happen. In July, Mike Linenberg from Deutsche Bank asked Bastian about the secular decline of the low-cost, low-fare group. Bastian's answer shifted registers. None of that exists any longer. All of that world has changed completely. The structural collapse of the LCC cost advantage on fuel, labor, airports, aircraft availability was described not as something Delta is watching happen, but as something Delta predicted and has built around. The narrative has tightened. In April, this was a view about the future. In July, it's stated as established fact. Whether the underlying business conditions have actually moved as decisively as the language suggests is a different question. Project Kuiper becomes Amazon Leo. In April, Bastian announced a game-changing partnership with Project Kuiper to bring next-generation satellite connectivity to Delta's aircraft. The framing was expansive, a platform for onboard digital engagement, a meaningful step forward. In July, starting in 2028, Amazon Leo will unlock the next generation of onboard connectivity, reach, and personalization. Same partnership, clarified timeline, different name. Project Kuiper is Amazon's satellite internet division. Amazon Leo appears to be the consumer-facing brand for the in-flight product. The rebranding itself is minor. What's notable is the language calibration. April's game-changing has become July's more measured operational description. And the next generation of onboard connectivity now has a specific year attached, 2028, which was absent in April. 3 exchanges from Friday's Q&A are worth tracking. On pricing durability, Connor Cunningham of Melius asked what gives Delta confidence that pricing will remain firm even if fuel moderates. Bastian's answer, the industry has no other choice. It's a direct answer, and one that shifts the burden. Delta's pricing confidence rests partly on the industry being structurally unable to compete on price. That is a different foundation than Delta's own execution. On peak margins, Jamie Baker asked what internal analysis management has done to assess peak pre-tax margins. Bastian said, I'm not sure what peak looks like. We're not there yet. The answer is expansive and philosophically interesting. Bastian tied the margin ceiling to brand loyalty, fleet efficiency, and AI. But the specific question about internal modeling of a margin ceiling was never directly answered. The word peak appeared once more in the call attributed to Bastian in passing, but the framework he offered was structural rather than analytical. On the refinery outage, Ravi Shankar of Morgan Stanley asked about the refinery's current status. Eric Snell disclosed that it was back to approximately 75% throughput after a recent outage, with a 5 to 7 cents Q3 cost tail remaining. Notably, the refinery had appeared in April's prepared remarks as a structural competitive advantage, a unique differentiator. The Q2 outage was disclosed only in Q&A response to a direct question, not in the prepared financial summary. The April call was about surviving an external shock. The July call is about claiming the shock as validation. That is not cynicism. The underlying results support it. Revenue grew 14% on 1% capacity. Operating margin came in at 9%, better than guided. The industry did rationalize capacity faster than in prior cycles, and Delta's diversified revenue base, American Express remuneration at $9 billion this year, corporate sales growing double digits, MRO expanding, cargo up 39%, did provide the buffer management said it would. What the Gap report tracks is not whether the performance was real, is how the communication evolved. The pilot contract, the specific internal problem named in April, is absent in July. Fuel is still elevated by half, but now framed as a test passed rather than a threat ongoing. The Middle East conflict that opened the April call with a humanitarian acknowledgement reappears in July as route expansion territory. These are not corrections. They are evolutions in emphasis, each one individually defensible, collectively forming a pattern. The question that neither transcript answers, when the next unexpected shock arrives, and Bastian said plainly there will be more, with the operational resilience that is now described as structurally improved holding away April implied it might not? The July call is confident. April was too, in its own way, about different things. That question remains open.